Hello and welcome to Finspire's Focus on the Markets. I'm Chris Karam, Finspire's Chief Investment Officer. The goal of the Focus on the Markets series of webcasts is to 1, inform investors of current economic and market conditions, 2, make sense of how global events interconnect and impact your money, and 3, do so in an efficient manner and be respectful of your time. So let's get started. We're going to share a combination of facts and figures mixed with some of our opinions about opportunities and the outlook. We will move swiftly through charts and connect the dots along the way. So let's jump into our agenda. Today we have 5 key areas of focus. 1, not surprisingly, we will start with the story of the year, the COVID-19 outbreak. 2nd, we will move on to the importance of plunging oil prices. 3, the next O is for offense. The Federal Reserve and Congress went on offense to combat the economic impact of the virus. 4, let's discuss current market opportunities. And 5, share our outlook of what to expect as we invest in a bear market. Before we continue, it's always helpful to frame current economic and market conditions by reviewing how we entered the current environment. Before COVID-19, we were experiencing 2+% economic growth, with record low unemployment and above inflation wage growth. The exponential spread of the virus encouraged the CDC to recommend strict guidelines of social engagement, triggering an economic recession and massive and rapid unemployment. This resulted in poor market results in the first quarter, extremely high levels of equity market volatility, and local communities setting their own rules for battling the spread. So let's start with what we know about the COVID-19 outbreak and its impact on your money. Over the last couple of weeks, we all have become familiar with these curve charts of how the number of COVID-19 cases around the world have exponentially grown. We are now seeing early indicators of these curves beginning to slow their rate of growth, and we of course want the number of recoveries to rise and deaths to decline. One of the things that we've learned during this, looking at these curves, in the United States, a heavy concentration of cases reside in New York City, which happens to be our most densely populated city in the country, and in the state of New Jersey, which happens to be the most densely populated state in the country. The COVID-19 is spreading at a rate commensurate with population density. And due to COVID-19, we had to say goodbye to the longest economic expansion in US history at just over 11 years of age. Most indicators signal a deep, yet perhaps short, recession is upon us as several business sectors ground to a halt. We saw that in recent jobless and unemployment reports from the government. The economic slowdown literally sent the number of weekly jobless claims seemingly, quote unquote, off the charts. The last 2 weekly reports tallied nearly 10 million unemployed, when we normally have a few 100,000 claims in a typical weekly report prior to the COVID-19 outbreak. The April 3rd jobs report, released by the Bureau of Labor and Statistics, indicated the leisure and hospitality sector was the hardest hit, with over 450,000 jobs lost in the month of March. Other service sectors hit hard were healthcare, business services, and retail trades. The bad news and uncertain news ushered in the most rapidly developed bear market in history. Despite the poor and sharply negative returns experienced from February 19th through March 31st, we are still up 268% cumulatively since the last market bottom reached on March 9 of 2009. So we do need to keep some of the recent downtrend in historical perspective. Market losses were not limited to the S&P 500 large US companies. Commodities, emerging markets, developed non-US markets, and US small cap equities all posted returns in the first quarter between -22 and -38%. Investment grade fixed income, particularly US Treasuries, were a bright spot for the quarter and prevented balanced portfolios from reaching the equity market lows. To compound factors, we had an oil price shock. The demand for oil, given the lack of overall global economic activity, plummeted and caused certain countries to engage in a high-stakes dispute that further exacerbated volatile equity markets. Namely, Russia and Saudi Arabia have not seen eye to eye on several geopolitical matters, which recently spilled over into oil markets. The Saudis decided to increase oil production by 1 million barrels a day on March 11th, right during a time of declining demand. This sent oil prices correspondingly plummeting to below $20 a barrel on March 29th. Oil prices began the year as a frame of reference at over $60 per barrel. This is problematic because here in the United States, we are now a net exporter of oil. We also have a tremendous amount of shale oil which is produced and which is usually more profitable when crude oil prices are in the $40 or above range. As these global events unfolded, it became clear that policymakers had to act boldly in order to calm the markets. Both the Federal Reserve and Congress acted accordingly. The Federal Reserve cut short-term interest rates in 2 emergency 50 basis point moves to a 0 interest rate target. The Fed also expanded their balance sheet with further monetary easing to accommodate liquidity needs in the credit markets. The Fed, in our view, acted quickly and forcefully and used their experience during the 2008-2009 financial crisis to try to prevent another crisis from occurring. It wasn't just the Federal Reserve. Congress also got in the act by passing a $2.2 trillion fiscal relief package, which included direct payments to individual taxpayers, a small business lending initiative, and loan guarantees to businesses participating in economic sectors hit the hardest. As you might imagine, the deficit is poised to balloon to historic levels while Congress provided this economic relief. So what do we do from here? As is the case with most major historical bear markets, investment opportunities develop near the end of a drawdown period. Market drawdowns are expected year to year, but pullbacks of negative 34% on the S&P 500, though not unprecedented, are more infrequent. The rapidity of the first quarter bear market does have some resemblance to the 1987 Black Monday market crash, where we experienced an intra-year 34% drawdown. However, the total return for the calendar year 1987 actually finished with a positive 2%. We do have a considerable amount of time to recoup the losses before 2020 comes to a close. Opportunities are not just in the US with lower stock prices. Valuations are lower all over the globe, but earnings reports loom large as many companies will have to pull back earnings guidance for the remainder of the year or until these stay-at-home guidelines are relaxed. Opportunities are not limited to equities. Corporate bond yield spreads over treasuries have widened similarly to opportunistic levels reached in early 2016. Higher yielding, lower quality debt may be attractively priced in this environment without assuming the same level of risk as being invested in equities. And how could you personally benefit from the current environment? Well, consulting with a mortgage expert may be on your horizon, as 30-year mortgage rates fell to 3.3% on average as of April 2nd, 2020. Whether you are a first-time home buyer or looking to refinance, this interest rate environment could present a personal planning opportunity for your mortgage. We know that oil prices at their current levels could hinder economic growth, but the consumption of gasoline, for those of us, of course, who are still driving frequently, is costing less and less. The average price paid was $2 per gallon on March 30th and was moving lower to start the month of April. This may also help the airline industry as they try to get back online later this year with lower fuel costs. In some respects, we have been here before. We've recovered from epidemics and survived bear markets. And here are some general expectations as we look ahead. The average bear market since World War II saw the S&P 500 lose 35% of its value over an 18-month period. The average recovery has taken 2 years and 2 months. We experienced this current bear market, however, in record fashion. It occurred in approximately 5 to 6 weeks. Thus, this recovery could be more rapid than other historical references if the spread of the virus begins to slide and local economies gradually reopen in phases throughout the country. We also have a track record of markets recovering from pandemics, such as SARS, H1N1, Ebola, and Zika. Admittedly, however, COVID-19 is voracious in its contagiousness and worldwide impact and presents a different economic challenge. But we can do this. Let's conclude our focus on the markets with a few areas to watch. Watch for improved mitigation figures from the CDC as we get more data in from expanded testing. We want oil prices to stabilize in order to experience a sustained equity market recovery. Personally plan for the fiscal relief package from Congress. Whether you are an individual or a business, that relief may come just at the right time. Recognize that bear markets present long-term investment opportunities in both equities and in parts of fixed income. But be patient. Don't try to actively trade when volatility remains elevated, and look for entry and exit points by establishing a strategy for the recovery. Lastly, engage with our Finspire team by visiting our website at finspireme.com, where you can read up on economic and market updates, determine your risk score, and get in a portfolio that's right for your tomorrow. All while contacting a financial professional to guide you through turbulent times. Thank you for listening and viewing today. We wish you safety and sanity until we visit with you again soon.